Guys, thanks for joining me today for our webinar on cash flow. My name is Kristy. I'm a presenter and an advisor for Business Station as part of the Digital Solutions program. Today, we're going to go through a range of different elements of cash flow, managing your cash flow, tracking your cash flow, and sort of trying to improve your cash flow as well. I will just add a bit of a disclaimer that I am not an accountant or a bookkeeper. So my experience really comes more from the operational side of owning and operating and running small businesses. So do keep that in mind. And if you do have any accountant specific questions, I would encourage you to reach out to a professional in that regard, or contact us as we do have advisors that have accounting experience as well. Now, the session today is designed to be interactive, so please use either the Q&A or the chat functionality to ask me questions at any time. I will also have some time at the end to answer questions, but feel free to shoot them through as we go as well. Okay, so what we're going to cover today, well, first of all, throughout the webinar, you'll gain an insight into the cash flow process and then ultimately learn how you can manage it. So we'll discuss what cash flow actually is. We'll talk about the difference between, or perhaps even the relationship between profit and loss and cash flow. You'll learn how to create your own cash flow forecast if you're not already forecasting cash flow. And then you also sort of discover how to develop more of an analytical approach to cash management by effectively tracking your performance as you go. Finally, we're going to look at, I should say, some strategies to stretch your cash flow even further. So even if you have a small business that is cash flow positive at the moment, that's fantastic. And there's always ways that you can increase that to have even more cash flow, which results hopefully profit. Okay, so first of all, what is cash flow? Well, cash flow is a term that is used to describe the amount of cash by way of actual dollars that's generated or consumed in a given time period. Cash flow has many uses in both operating a business and in performing financial analysis. And I think it's one of the most important metrics in all of finance and accounting because it really is the lifeblood of a company. By tracking your cash flow, you're able to evaluate the flow of funds in and out of the business at any given time and identify where and also when there are potential problems. So the when can be a big factor as well. So understanding your cash flow is an absolute key to business success. And as you find out how to manage it, you can learn how to stretch it further. So in terms of cash flow versus profitability, profitability is the ultimate goal when it comes to the financial side of running a business, but you don't generally determine true profitability until the end of a period of time. So normally that's the end of a financial year. Where you look and you go, how do we do this year? Hopefully it was well. You sort of have a sense as you're going whether or not you're doing well based on the amount of cash that you've got readily available. But profit and loss is generally determined at the end of a quarter or the end of a financial year. So that's really the key difference between cash flow and profit. Profit is retrospective and generally looks backwards, whereas cash flow is forward focused. Profit is essentially the amount of money that's left over after all of your expenses have been paid. And that could be, like I said, at the end of a financial year or the end of a quarter. And making a profit, put very, very simply, essentially means that you've sold enough of your product or service to cover all of your existing costs, which are your expenses, and you've got a little bit extra to spare. Cash flow then indicates that net flow of cash into and out of a business at any particular time. So that could be outlined in weeks, it could be months, it could be years. That really depends on how you set up your reporting. And I'll show you some examples of that, but ideally, and the most common, it tends to be by way of months. Some businesses might be up and down week to week and monitor things on a weekly basis, but that's a lot of data as opposed to months, which simplifies things a little bit. Now, cash flow does matter and it matters a lot. Having good or having positive cash flow means that you're going to have enough money to pay all of your expected expenses when they're due. You'll know when you're able to reinvest in your business or potentially purchase capital or other assets that are required to grow your business or even to run it more efficiently. You'll also see when it's appropriate to return money to other shareholders or take money out for yourself. So that side of positive, of cash flow is obviously the positive sense. You'll also be assured that you've got a bit of a buffer to cover you against any future financial challenges. Now, sometimes those future financial challenges are unexpected, equipment replacement, for example, or you might have legal expenses or anything that's completely unforeseen. Things do pop up. So understanding your cash position and making sure that you have good or positive cash flow gives you that reassurance that if something does pop up, you'll be able to cover it. On the flip side of that, having cash flow problems means that, and when you look at tracking your cash flow, if you've got cash flow problems, you won't have enough money in the bank for the necessary expenses or operating costs of your business, let alone anything unexpected. So that is really, really important to understand as well. You have to keep in mind also with small business that you can have profitability, but still suffer from cash flow problems. So some common causes of that are having clients that pay late. Perhaps you've got bad or early paying terms to your suppliers. And those are sort of the two main reasons why you can be profitable but have cash flow issues. But figuring out your cash cycle and your payment terms to sort of sort those two problems out is really one of the first things you have to do to keep cash flow positive. Now, in terms of your cash flow, in an existing business, I would recommend that you continually analyze your cash flow so that you start to understand trends and how the business operates. But if you're a startup, your first goal would be to maintain a positive cash flow. Once that's under control, you would then be trying to pursue that ultimate goal of making it as profitable as possible. Okay, so that's where tracking your cash flow comes into it. Tracking cash flow allows you to operate profitably and generate positive cash flow, or to make necessary changes to improve your cash flow. So for example, you might identify that you need to reduce certain expenses, or that there's times where you absolutely have to increase revenue in particular areas to be able to survive. It allows you to look at what's working well and what's perhaps not working by way of breaking down times of year, products, services, that kind of thing. You should be able to set budgets based on what you know you need to achieve at certain times, and then track it to make sure that you're meeting those budgets or those targets. It also allows you to be sure that you have enough cash, or if you, in the case that you don't, and there are periods of time where you just don't have the cash, you'll have to determine how you can get some cash into the business. Now, that could be that you need to personally invest in the business. It could be that you need to seek the help of investors, or you have to sell assets or look at some borrowing from a bank. It also allows you to make informed decisions on a range of different areas in your business, but that could be anything from purchasing, from staffing, sales, leasing, renting space, where and what size space you're renting, that kind of thing. So with all of that knowledge, you are a lot more likely to be able to actually reach your business goals or work out methods and strategies to achieve your business goals. Now, because cash flow matters so much, it's only natural that you should do everything in your power to increase it. So forecasting and knowing exactly when you'll have inflows and outflows becomes absolutely crucial. To do that, you have to map it all out. There's a lot of different templates available online. I find the best and the ones that I like to use are those that are available on the Australian government website. But banks and a range of other organisations have these cash flow forecasts that are normally downloadable, normally in an Excel format, and generally they're free. So I'm going to go through an example in just a minute. Keep in mind that your financial software as well, so your bookkeeping software may also have the ability for you to create a cash flow forecast within the software. So have a look into that. But once you've got your template, to get started, you will have decided the period that your forecast should cover. You'll add in all the cash inflows, and then you'll also input all of the cash outflows for each period, usually month by month, which I'll show you on a template shortly. Now, if you've got an existing business, a great way to start that is to get all of your data from previous years and input it into your forecasts. So pull a MIOB report, pull a Xero report that shows you previous financial year's expenses, for example, and sales for that matter, and then input it all into your template. Then decide what adjustments you'll need to make. So you could have purchased a large piece of machinery, for example, last financial year. You can see that on your report in your financial or in your accounting software, but you're not going to input it in this year because you know it's not going to happen again. So basically you make some adjustments based on what you know from each of those expenses. There might be some other adjustments that you'll make to sales based on past trends. So you might know that sales are there's a trend towards them increasing or decreasing, or you might anticipate that they'll stay the same. So in terms of forecasting and budgeting, you'll have to make some assumptions. Now, if you're a new business, when you prepare your cash flow forecast, you have to start by estimating all the cash outflows. If you do that, you'll get an idea of exactly how much cash needs to come in to cover, at the very least, the cash that's outgoing. And therefore, that kind of tells you what the minimum sales are that you'll need to make. Now, to be able to get some of those estimations, you might have to get quotes from insurance companies, from information from different software providers, or however and whoever that's involved in your business. And obviously that changes greatly from business to business. But really consider absolutely everything. Consider operating costs, administrative costs, human resource costs, absolutely everything that will come out of the business. Now, do keep in mind that sales figures always change because they are dependent on a range of different factors. Now, these factors incorporate the types of customers that you sell to, how quickly these customers have to pay you, what the economy is doing. So there could be interest rate increases, there could be higher unemployment rates, and therefore, customer spend is either increased or decreased. You obviously have to know what your competitors are doing. So consider all of that when you're sort of budgeting and forecasting your sales, and be realistic when you are forecasting. Now, that really helps you because, and part of what I'll sort of go through today is comparing your actuals to what you've budgeted and what you've forecast. It's so important that when you're doing this analysis and this forecasting, that you are as accurate and realistic as possible. Because there's no point putting unrealistic information in there, because you're just going to be let down either way. Well, you're going to be let down if it's under in terms of sales and your expenses are higher. So keep that in mind. Okay, so we'll have a quick look at the template now. Now, this is a basic template that is available from I think this one is the business.gov.au website. But like I said, there's a range of different templates that you can access. This is a good one to look at. It's a very, very simple format. Essentially, you have an opening balance here. So that's this one is based on financial year. But with these templates, anything you see here, and this particular one in blue, is editable. The greys will have a formula that is calculated when you input into the blue areas. So this one starts beginning of financial year. Your business may operate more on a calendar year, so you can input and make this cash flow forecast for whatever period you want. But the most common, again, is financial year. So you have an opening balance. You would input something into your opening balance. Now that's because this is about cash and cash flow. So this is the cash that you've got in your bank. From here, you'd be inputting your estimated sales for each month. Now, that would be product or service sales. You might want to break that down per product or service. If you're planning to sell an asset, you might map that in here on the month that you're planning to sell it. You may have sales in 1 month, but you've got debtors that have 30 days to pay, for example. So you might, have direct cash sales here for the month of July. You then might sell some things in July, but the debtor receipts don't come into August. So the sales that you made in July could in fact be spread over different months. If you're planning to get a loan from the bank, you might want to map that in, or any other income. So any cash that's coming into the business, and that could even be your own loans or your own inputs. Then the next part is cash outgoing. Now, there's some examples there of different outgoings that you might want to consider. This side is all editable as well, so you can very much make it your own, but things to consider are your purchases. So whatever you're purchasing, obviously there will be a cost attached to it. You might make purchases at certain times of year for stock, for example, but sell it at other times of the year. So it's important to map it out when you're actually purchasing it. Accountant, legal fees, any advertising and marketing, obviously bank fees and charges. If you do have any loans, the interest that will be paid on those loans, credit card fees, basic operating costs like utilities, phone, rent and rates, lease or loan payments are important. And then you've got things like motor vehicle, repairs and maintenance, stationery and printing, membership, licensing, insurance, super, income tax and wages are all very important that you map in there as well. Keep in mind that you might pay wages on a certain date, but superannuation is due quarterly. So again, map that out when it occurs. This is all about the timing of cash flow. So your super isn't paid on the actual the month that the employee is paid. It could be paid quarterly, for example. So really think about your business and use these sort of elements as, I guess, indicators or as a guide, but really tailor it to suit your business. So as much detail as you can put in here as possible, and as accurate as possible is going to be really important as well. So keep that in mind. Add your cash inflows, then your cash outflows, or vice versa. Certainly, as I said earlier, use your accounting software and use past data as a starting point. So if you were to do this today and you've been operating for a couple of years, I'd be pulling my accounting software reports from the 21 and 22 financial years and start having a look at all of these elements over here. What was the, what were the utilities for that for the 2 years, and then have a look at how that changed, for example. Same as any other expenses, map them out based on what you already know, and then allow for some increases if that's relevant. Don't forget, if you do take some money out, so let's say you've got a small business, you're the owner of the business, you take some money out. A lot of owners, and we will talk about this as we go today, but a lot of small businesses will take that out sporadically. They'll see a bit of cash in the bank and go, you know what, I'm going to take some out now because I can. But I would encourage you to look at it more from a, a strategic perspective and actually map it out. So work out at what times you're going to take back some money. If you're not being paid a wage, of course, and you're just doing director's drawings or something like that, really account for it by way of your cash flow so that you can make sure that you actually can afford to do it on the time that you are planning to, because that's a really key thing. But like I said, we'll touch on that a little bit later. So that's an example of a template, but I'd encourage you to have a look and download one that you like. And there's no right or wrong by way of templates. So now we're going to get into the good part and start to look at strategies for actually improving your cash flow. Once you've mapped it all out and you're all set up to track it, you should very quickly identify if you need to improve it. Now, there could be a profit or a loss showing on your cash flow statement. I'll just quickly go back to this template just to quickly show you. So what it's going to do here is total your incoming for that particular month. Then it's going to total your outgoing. So it's going to give you a monthly cash balance. So your incoming less your outgoing is going to give you a cash balance for that particular month. It's then going to give you a rolling or a closing balance, and that's going to take into consideration how much money you had in the bank. So if you had $5,000 in the bank, you made $1,000 in sales in that month, that's $6,000, and you had $4,000 expenses, it's going to show a closing balance of $2,000 here. So your monthly cash balance will just tell you what that month looks like, whereas your closing balance is going to tell you how you're tracking. Now, your closing balance becomes really important because you might have seasonality. So you might have good seasons, bad seasons, and you might have, a really busy summer, for example, and you know that you've got to keep that cash in the bank to get you through a quieter period of time in the winter. So you can sort of see that roll on as you start to look at the forecast. So keep that in mind. So whether there's a profit or a loss showing in your cash flow, you still should be looking at ways to improve it. There are strategies for improving cash flow, and they generally fall into one of three categories. The first category is revenue growth. then you've got your operating margin, and then you've got capital efficiency. So we're going to have a look at some of the specific areas within those three main pillars, but it's definitely worthwhile looking at all areas of your cash flow. Obviously, you'll need to consider what's relevant to your specific business. Now, some of the things that you see on the screen just won't be relevant to many businesses out there, whereas, you know, you might have a business where all of them are relevant. I'd also encourage you to keep in mind that a lot of what we're going to talk about really does come down to marketing. It's strategic marketing, but first you have to understand your position to be able to improve your marketing and subsequently improve your cash flow. So let's just expand on those three main pillars. First of all, you've got revenue growth. Now, revenue growth is essentially the volume of goods or services sold and the price of what you're selling it for. Your operating margins is the second pillar. Now, that really comes down to the cost of goods sold and your selling, your general and administrative expenses as well. And then that third pillar is capital efficiency. And that is a question of how efficiently you're using your cash to operate and grow. So looking at things like property, plant and equipment and inventory. Now, there's a lot of sub sort of areas that fall under those three main pillars. Like I said, we're not going to go into all of them, but we will start going through some of the core elements now. And we'll start with pricing. Now, so many businesses that I deal with or work with, and when I first start talking with them, one of the main questions that I'll ask is, you know, what is your most profitable or what are your least profitable products and services? And businesses just don't tend to track this information or know. So they don't really know if their pricing is right, if their prices even cover costs, or if specific products or services are actually profitable or do better than others. So thinking about your business, what are your most or your least profitable products and services? I would also consider how you can increase the products that are most profitable and decrease the sale of the least profitable, or decrease the input of time that you're investing in your less profitable products. I would consider how much time is invested in them all. Once you've set your prices, or when you've set your prices, also have a look at how you've set them. So how have you determined what you're actually charging? Now, there's no right or wrong to a pricing strategy because it is unique to a business. But the three things that you really have to consider when it comes to pricing is what the product or service actually costs you. And you have to be making money on what it costs you to deliver. You have to know what your competitors are doing. Now, what are your competitors selling it for? Are you more expensive, less expensive than them? And the third element is you have to know what your customers are willing to pay. Now, to know what your customers are willing to pay, you really have to understand your customer very well. And this is where the marketing side of it comes into it. You have to really define and clearly understand who your core target market is. You have to look at all three of those elements to be effective when it comes to setting your pricing. You can't just base your pricing on what it costs you plus a markup, because you might not be competitive. You can't just base your pricing on what the customer is willing to pay or what your competitors are doing, because you might not be covering costs or making a profit. So you have to really look into all elements. You have to do a full competitor analysis and know what they're doing. And you really have to analyze who you are as a business against your competitors as well, so that you know your worth. If you've got weaknesses or gaps in what you're offering, and these are identified when you're doing some research on your competitors, look at ways of closing those gaps and really minimizing those weaknesses so that you can offer a superior or a fantastic product or service that is superior to your competitors. What is it about your product or service that's unique or different? What sets you aside from your competitors? And can you charge more because of that, regardless of what your competitors are doing? Some organizations work on the basis that they want to sell more volume and make less profit. But keep in mind, when it comes to pricing, that discounting equates to more work to make or maintain a margin, whereas increasing your price is less work and fewer customers to maintain your margin. Now, if you do increase your prices, though, you could potentially cut out a market. So, you might get to that tipping point where your pricing is just that little bit too high, and you price out a certain market. That could mean that you attract a better market, just fewer customers. But on the flip side of that, some businesses work on the basis of decreasing the price so that they can get more volume. But decreasing a price can also mean that you attract the wrong market as well. So there's a really fine line when it comes to pricing, and sometimes you have to test and tweak your pricing and see how it goes. Some examples of discounting that I see that don't work overly effectively, or they can, I should say, but in some instances they don't, are things like your group buying websites, where you've got your Groupon, Scoopon, those kind of sites where the prices are absolutely slashed, and they do attract a lot of sales for a small business. So you attract a lot more customers, but you have to ask yourself, are they going to be the right kind of customers? Are they going to be as easily satisfied? Are they going to spend as much with you on repeat purchases or on additional products and services in addition to the voucher that they've purchased? And are they going to be loyal? And in a lot of cases, you find that they're actually not going to, the type of customer that looks for a deal and has no loyalty whatsoever. And, keeping in mind things from a marketing perspective, along the lines of it costs about 8 times more to attract a new customer than it does to retain an existing customer. Is it actually worth it to get that volume of sales? So really understand your own business and your customer behavior before you make those kind of pricing decisions. The next element we're going to look at is volume. Now, volume is essentially how much of your product or service you're selling. Now, the question here is, can you increase your volume overall, or specifically the volume of more profitable products and services? Or would there be new markets to sell to? Could you create a new product, or could you improve your sales processes to be able to produce more? There is also a few options by way of the profit enhancement model that you see on your screen. Now, this is a really interesting one because it allows you to really have a look at what you're going to do with your business and work out what the profit enhancement strategy is. So it can be retrospective. You can go, all right, yes, this is what we're going to do, and this is who it's going to attract. So I'll run through those. The first one is, the blue one is market penetration. So that's where you're selling your existing product to an existing market. So basically that's when a business is trying to gain a competitor's customers. So you're trying to get more customers. Product development is the green. Now this is developing new products for existing markets. So thinking about your business, can you launch a new product or service? Maybe, when you were researching and looking at your competitors, you've identified a new product that you could potentially develop and offer. Sometimes just through tracking trends and understanding your customers, you see that there's a trend emerging and that you need to develop a product or service to suit a changing demand from your customers, or a change in wants and needs. Then you've got market development, which is what you see there in the orange. Now, this is selling existing products to a new market. So you're developing new markets, and potentially broadening your scope to a different market that you haven't attracted before. We saw a lot of this throughout COVID, where businesses that were potentially bricks and mortar and, didn't have that foot traffic would go online, or, maybe you were an online store that didn't sell as much through a difficult time. So you open a pop-up store, those kind of things. So you do have an existing product, but you're just looking for an entirely new market. Then you've got diversification, which is in the red. Now, this is probably the most risky of all the profit enhancement strategies. This is where you're looking for a new market for a new product. So you're spreading into a new area, selling something different to your existing core product. Now, you have to be really careful by way of diversification that it doesn't take away from your existing business model, and it doesn't confuse the market either. So if you, for example, sell a particular range of products or service, then all of a sudden you're selling something completely new that's appealing to a new market. is it confusing to your existing customers, or does it make sense and tie in? One thing you don't want to do is take your attention and your focus away from your core business to focus on something else and then neglect the original sort of area of your business. But it still is a profit enhancement strategy. Now, in terms of volume, you also have to consider what your sales processes are like. There could be blockages in the sales process, and so you have to consider if there could be better processes, could allow you to sell more. So look out for any bottlenecks or any issues there, and that could be in production or sales. Thinking of increasing advertising, obviously any increase in advertising will have a spend attached to it, but if you're advertising more, you should be selling more. If you've got salespeople, they can be really helpful in selling more volume. If they're good, obviously you need to have a good plan in place to retain them. If you need salespeople, a good plan in place to attract them to your business in the first instance. The other thing is, I mentioned that statistic of it costing 8 times more to attract a new customer than it does to retain an existing customer. I would look at, things like customer rewards programs. What can you do to sell more to existing customers, get people back, get that repeat purchase really a lot stronger within your business to increase the volume of sales, but also decrease how much it's costing you to get that person to purchase, if that makes sense. The next area to improve your cash flow sits within your debtors. Now, the ATO has some really interesting stats around debtors, and one of those stats is that small businesses in Australia are owed around $26 billion at any one time due to debtors. So you want to obviously not be a part of that 26 billion and try and get that cash in as quickly as possible. Now, the best ways to address any issues with debtors are, first of all, to collect payments as quickly as you can. You might want to offer a discount for prompt payment or introduce late payment fees, something along those lines, whatever's going to be most suitable to your business. I would also look at invoicing earlier. So maybe not the end of the month, maybe send invoices straight away if you've got debtors. Now, keep in mind also that not all businesses have debtors. So you might be, direct consumer focused and they pay as they go, which is fantastic. But in the case that you do have debtors, certainly have a look at their purchase cycles. Now, as part of my other business, one of the debtors that I deal with, or one of the suppliers, that I deal with, we can go into their store, purchase the product, and by the time I've got into my car, an invoice has been generated. So that gets input into our system straight away as it's received, and we pay according to that cycle. So we might go in there and purchase things several times per month, but that invoice is automatically generated. They'll send us a statement at the end of the month, but their systems and processes are so streamlined that it's not taking them a significant amount more time to actually generate that invoice, and it's not double handling as such, but they would be getting the payments a lot quicker. So maybe consider something like that. Or even if you've got customers that purchase repeatedly from you throughout a month, perhaps even splitting the month. So not waiting to the end of the month to send an invoice for absolutely everything, but doing a 15th of the month and then a 31st or 30th of the month invoice run, so that you've got kind of two options, or split the month into two. I would also look at reducing your terms, so making those terms shorter than 30 days. A lot of organizations are still going for that 30 day, and it seems a little bit old fashioned now. 7 days or 14 days, it will be a lot better. So just think about your business. If you provided a product or service on the 1st of the month, you then waited until the 30th or 31st of the month to actually invoice, and then you gave them 30 days to pay, that's potentially 60 days that you're out of pocket. So really look at those, at both invoicing earlier and reducing your terms, and see what you can do there. Now, I would also look at electronic invoicing. There's a lot of fantastic accounting software out there at the moment that obviously allows you to issue an invoice straight away and offers follow-up services. Anything electronic is going to be a lot more professional than anything that's mailed out. It's obviously easier to send, it's easier to store, it really reduces those turnaround times. Some good software also will offer follow-up services, as I mentioned, and those payments will be followed up really promptly if they're not paid on time. Now, the more automated the payment follow-up, the quicker you're going to get paid, and the less time you'll need to input to actually get payments in. So definitely consider that. The other thing to consider is e-invoicing. This is a new sort of technology or an emerging technology, which is the automated digital exchange of invoice information directly between a supplier and a buyer's accounting system. So with the introduction of e-invoicing, you won't even need to generate a PDF or any kind of invoice. You're basically connected to the same e-invoicing network, and you can use accounting software like Xero to send and receive e-invoices, essentially. Now, another ATO stat is that it can cost around $30 per invoice to produce a paper or a PDF, so even just an email PDF invoice. And that with e-invoicing reduces down to less than $10 per invoice. So there's some good cost savings with that one as well. The last thing that I don't have on the screen that I would recommend is really just make paying easy. So offer multiple payment methods to your customers. Have a look at how they can pay you. Is it bank deposit? Do you have BPay? Do you have credit card? You know, can they pay there and then? So just consider making paying easy and offering multiple methods so that your customers can choose the payment method that best suits you. Okay, the next area we're looking at now is assets. Assets is fairly straightforward. It's simply to look at if you can free up any cash by selling underused or unused assets. Now, businesses tend to accumulate assets, and at certain points they don't require those assets anymore. So look at selling unnecessary assets to increase the cash in your business. That could also save you on costs like storage or insurance and those kind of things. I would look at leasing to free up cash. So, you know, depending on your business, it might work out better for you, and it may completely remove the cost of maintenance and the risk of complete failure that requires replacement if you look at leasing equipment within your business. Now, the other thing you have to keep in mind is that leasing smooths out cash flow. So if it's appropriate for your business, it can be a really good way to free up cash. You may even be able to scale equipment or products and services up and down based on demand as well. So if there's certain times of year that you don't need a particular piece of equipment and you're leasing it, perhaps you can hand it back so that you're not paying any costs for it while you're not utilizing it. I'd also look at refinancing or negotiating better terms with any existing loans or bank agreements that you might have. So, you know, in terms of assets, there could be better deals out there or better ways to be able to pay for those assets. So that side of it's pretty straightforward. Then we've got the expenses side of things. Now, put it very simply, expenses decrease the amount of cash that's available to your business. So have a think when it comes to expenses about what you can do to reduce them. Sometimes you can defer expenses or look at better payment terms. So let's say you've identified a really difficult time of year where let's say it's winter and your income drops right down. Do you need to pay for those expenses at that time, or can you sort of shift the payment or even negotiate better payment terms around particular expenses? I'll look at cheaper alternatives. So, you know, it could be as far as, let's say, your premises. Can you rent a cheaper location, or could you negotiate a better deal with your current lease? Are there cheaper alternatives to any of the expenses listed? So I look at even the little things like your you know, tech packages or your phone plans, or have a look at what kind of subscriptions you have. Can any of those be removed entirely? Have a think about them. And when was the last time you reviewed things like insurances? Have you got quotes from multiple companies to make sure that you're getting the best deal? I would also look at the comparison in outsourcing versus in-house staffing. Now, that can be really effective for specialist roles or particular tasks within your business. For example, and a couple of common ones are bookkeeping, particularly with more automation. Perhaps there's a bookkeeper that doesn't have to be full-time or even permanent part-time within your business. They can just do an hour or so a day and still achieve the same result. Or marketing is another good one for outsourcing, and sometimes other administrative roles as well. Now, we will talk about staffing in just a second, so I'll expand on that and why I think outsourcing can be a really good idea and a really big win for cash flow as well. Inventory is the next area we're going to look at. Now, inventory isn't relevant to all businesses, so do keep that in mind. It's only relevant to businesses that hold stock. But inventory represents cash. So if you're holding it for more than 90 days, it can cost you significantly, or any amount of time that you're holding it for, it will cost you, basically. So in terms of your inventory, think about whether you could source cheaper stock or materials first and foremost. I would be constantly reviewing pricing from suppliers. Now, that doesn't mean that you have to jeopardize relationships, but I think it's really important that you are checking on suppliers. Sometimes new suppliers can come into the market. Sometimes differing products can come into the market. If you've got a supplier, let's say you've got someone that you've worked with for a number of years and you're very happy with what they're offering you, it can't hurt to get quotes, to shop around a little bit, even if you end up going back to your original supplier and saying, look, I do want to stay working with you, but I have been able to source an alternative. These are the details. Can you match it and see what they can do? Chances are they're not going to want to lose your business, so they might sharpen their pencil on their rates a little bit. Purchasing power is a really interesting one. You've got buying power when you understand your own cash cycle. So when you map out how much cash you have at certain times of the year, and you compare that with how much stock you use or you sell, you might be able to see if there's any efficiencies there. So let's say you always have a great summer, for example, and I use seasonality because it's easy, but there could be other things that impact your fluctuating sales. But you know, you've got a period of time where you've got excess cash in the bank. Now, you could greatly benefit by reduced prices on some of your stock if you bought bigger quantities rather than buying dribs and drabs throughout the year. So always have a look for those efficiencies. In saying that, with your stock, you have to maintain the right levels. You don't want your stock to be too high because it's basically cash that you're sitting on. But you also never want to run out. So you've got to be really careful on that. You've got to track the movement of your stock and have processes in place to identify when that new stock should be ordered. You can have a look at supplier terms and, you know, see what kind of supplier agreements you got. But in the past, you could return, generally speaking, a lot of suppliers would allow you to return anything that was unsold if you had stock that just wasn't moving. But since COVID has happened, I think a lot of suppliers have really cracked down on that. So they're not accepting return stock, because what happened, obviously, COVID hit, everyone tried to return everything to get cash back in their business because they knew that they just wouldn't have or wouldn't be making the sales. So that might not be relevant anymore. But just really understand your supplier return policies. What's going to happen with a supplier if you get stock from them that you just cannot move? If you can't return it, you might want to think about how you can move it faster. Perhaps you've got a bricks and mortar store. You might want to pop some things online, or vice versa. You might have an online store, things aren't selling, do a bit of a pop-up markets, those kind of things to move stock. I'd really encourage you to use some kind of software platform to manage inventory, or you can do it manually by way of spreadsheets and that kind of thing, but really look at replacing slow moving or obsolete stock with stock that has that faster turnover. So really understand what sells well and what doesn't. You can look at drop shipping or just-in-time stock orders. They can be great. You need to find a supplier that will provide you with stock only when you need it, so that you're not paying money for stock that's sitting in a warehouse or a storeroom, for example. So essentially how that works is that you only order once you've had an order from your customer. But you really have to be careful with delivery, accuracy. I've heard some absolute horror stories about the wrong products getting delivered to customers. You lose the ability, that quality assurance ability to check out the stock, make sure it's the right quality, and then pass it on to your customers. So you do lose a bit of that customer service element. So make sure that that's right for your products, your services, and your business as well. The last thing I would say is really make use of supplier terms, make full use of your terms of trade, because that does equate to an interest-free loan. So don't pay invoices early, pay them when they're due, but also look to work with suppliers that offer you the best payment terms. So if you had a choice of 2 suppliers, one was cash on delivery and one gave you 30-day terms, obviously that's 30 days where you're getting an interest-free loan essentially on the stock that you've ordered. So go with the supplier that has the better terms, but keep a lookout for that. And that might be something that you're able to negotiate as well. Now, staffing, I did say that we would talk about this more. There's a few elements to staffing, and when it comes to staffing, it is a key area that can become a major expense for businesses. So first of all, in terms of staff management, rostering to cover demand to produce revenue is absolutely necessary. But then being careful not to overstaff is really important as well. So always matching the roster system to peak periods or having flexible staffing arrangements in place is highly recommended. As I mentioned earlier about outsourcing, there could be specialist roles that you could outsource so that you're only paying on demand as such, rather than having a full-time employee in those particular roles. I'd also look at increasing the flexibility of workers, thinking about the individual. Can they have flexible roles, or being able to multitask as and when they're sort of needed, for example, so that you don't have a double up or duplications of staff in certain roles. Aside from multitasking or having flexible workers, maximum utilization of staff is absolutely crucial. Thinking about that, can you set targets to maximize productivity of each staff member? Could you incentivize sales with commissions, or even look at rewarding staff behavior that improves cash flow? So if staff can reduce their expenses, for example, that could be something that's incentivized. But setting sales targets is always a great incentive. You have to make sure that you're only paying commissions or bonuses based on sales targets when you have the payment, again, so that it doesn't negatively impact your cash flow. But let's say, there's sales targets, wait till you've got the money from the customer before that target or before that bonus is paid to your staff member. So utilization of staff is what we were talking about there. Qualifications of staff is crucial. I would highly recommend to employ more qualified staff. Now, paying a staff member that's more qualified can hugely increase your sales and your customer satisfaction. And that in turn results in positive word of mouth, repeat customers, and a range of other benefits. But what you have to keep in mind is, looking at cash flow, unqualified staff may look like a quick and an easy win, but it can in fact be quite damaging in the long run. So I use this example of hospitality because you see it a lot in hospitality, and you might have someone serving you or waiting your table, for example. You ask them a bit about the menu, they're unsure, conversation skills aren't great. You don't order as much as if you had someone that was a lot more confident in terms of recommendations, on selling, upselling, those kind of things. So it doesn't even have to be more qualified staff as in what they've got on paper, but really having staff that have a sales focus and really understand customer service. So those 2 elements, sales and customer service, will greatly increase on-selling, upselling, cross-selling, which will increase profits and obviously increase your cash flow. So have a look at that. Retention then becomes an absolutely key element. You have to reduce that staff turnover, and that should be a big goal within every business. Staff turnover has a very serious impact to the bottom line. Staff are expensive to hire, they're expensive to train. Avoid those costs, they're unnecessary costs if you're an employer of choice. And if you become, one of those employers where an organisation that staff will want to be at, you'll save a lot of money. And again, looks fantastic from a cash flow perspective. Now, once you've got staff that are the perfect fit for your business, obviously employment is a key factor, but make sure that you've got steps in place to really keep those staff once you've identified that they are a good fit. You can check up on staff by way of how satisfied they are in their job, regular performance sort of appraisals, but getting feedback from them as to tracking their satisfaction as well. Checking in on your culture. Yes, your company culture is a really key element of that as well. All right, so that covers a few different strategies to improve your cash flow. Now, as I mentioned, we didn't go through absolutely everything, just those that are most relevant to the majority of businesses. But as you go through and complete your cash flow forecast, keep those strategies in mind. And then when you get to the point that you've determined if you have a profit or a loss, or if you have a cash flow issue or not for a particular time period, you'll have to make some considerations. Now, when it comes to profit, I would say don't be too quick to take it out. Invest it back into the business, or keep it in there to manage cash flow for future months and years. And you will have identified if there are any upcoming months or even years for that matter that could be an issue, or potentially even use it to pay down debt. If your forecast shows a loss, then you might have to look at how you can input your own money by way of director contributions. You may have to look at getting equity from investors, or you may have to speak to a lender and borrow to fill gaps. So you might have to speak to your bank about an overdraft even. Now, an overdraft is a simple and a very common solution to things like seasonal cash flow or even debtor cash flow issues. Most people are able to, to get an overdraft fairly simply and easily from their bank if you've got a bit of a proven track record with a bank. Now, the very final step, and I think what is the most important step of all, is to make sure that you're continually reviewing your estimated cash flows against your actuals. Make sure that you go back and check that what you estimated and what you anticipated your cash flow would be, and what it actually is for each specific period. Now, when you're doing that, highlight any differences between the estimated and actual, and try and determine why your cash flow didn't meet your expectations. It could have been lower sales than forecast, or it could have been higher expenses. It could have been one-off expenses, something unexpected, but you'll have to take different actions for different situations. Now, you also have to keep in mind that cash flow is all about the timing of this flow of cash. So when you're preparing your cash flow forecast, make sure you are as accurate as possible on the timing of cash flows, so that when you're comparing the forecast to the actuals, it actually makes sense. Otherwise, you might have, every second month sort of makes sense. So really think about the timing of that flow of cash. Now, in terms of cash flow mistakes, the biggest and most common mistakes that I tend to see are, and I guess probably the most common of all, is running a business from your bank balance. It doesn't account for any planned or unplanned expenses. It doesn't account for a seasonal nature of your business if you've got a high and a low season. So really be careful of that. Improper management of taxes and government expenses is also another area that I see is a simple, and it is a big and a common mistake, but it's a simple one to overcome. Those taxes are clear, they're known, so plan for them. And the things I'm talking about are your GST, your super, your PAYG, those things that are directly related to wages or income. So keep in mind there's penalties for late payments. So it's simple to account for those taxes. Do it in the planning stages and make sure that they're paid on time. Spending too much on sales can be a big cash flow mistake. As small businesses, I tend to see that the focus is on acquiring new customers, but you have to look at what the cost is that you are actually acquiring them for. Are you tracking that acquisition cost? And then are you tracking the total revenue of each customer to make sure that it's higher than the acquisition cost? You can do a massive marketing campaign or an advertising campaign, get a ton of sales, but do the sales exceed the actual cost of advertising? Also, overspending on that acquisition cost can lead to you getting a new customer, but a small value customer that has a limited return. So you don't always think that the more customers you have, the better your profit is going to be. And discounting comes into account there. When you know what your value is to customers and you know how much the acquisition cost is plus the cost of sales, then you should be able to determine how much you can charge or how much you can afford to discount as well. Obviously, other mistake I see is not forecasting. We've gone through that today, so hopefully you will be forecasting, not collecting cash fast enough, as we mentioned, and holding that inventory for too long. Taking too much cash out as a small business owner is also a big mistake. Now, a lot of small business owners don't get a wage from their business because they're trying to keep cash in the business, but then they're sporadically taking out money, which is almost counterproductive. It's better to be sort of planned and have it spread across the cash flow. Again, smoothing your cash flow than it is to just take lump sums when you think you can. But make sure, no matter which way you do it, that you're actually mapping it out. Now, if you suffer from negative cash flow, you can recover from it by just going through those strategies that we've discussed. So start looking at each and every element and see what you can do across each area of your business to improve that cash flow. But first of all, look at what caused the issue in the first place. Is it lower sales? Is it higher expenses? Is it a one-off expense? That's something unexpected. You might have to run a promotion to get new sales or somehow approach new clients or even meet with a lender or investor. But all of that stuff does take time, which is why being, tracking it and planning for positive cash flow is a lot more simple, than being reactive after the fact. Okay, so that wraps up the session on cash flow. I hope it makes sense to you, and I do hope there's some things that you can take out of this to improve, or at the very least better understand the cash flow position in your business at any given time of year, which is kind of the key thing. I'm going to stay on now and answer any questions that you might have, so please shoot them through by way of chat or the Q&A functionality. Also keep in mind, we have just scratched the surface. If you want to know more or talk about any other aspect of your business, as part of the Digital Solutions Program, which is a Commonwealth Government subsidised program, you can book a one-on-one appointment with one of our advisors. Now, we will talk about anything from cash flow right through to any digital technology, so keep that in mind. But thanks so much for your time. I do hope that we get to chat again soon. If you're interested in joining the program, just keep in mind there's a little bit of eligibility. You have to be based in WA, Queensland or NT to register through us. You have to be operating for profit and employ fewer than 20 full-time staff. And there is a link on your screen if you want to know more. But thanks again. Good luck with your cash flow, and hopefully we get to chat soon.